Good morning, everyone. My name is Richard Hernandez, and I'm the director of the Regional Economic Development Center here at Yavapai College. I'm also your host, so if there's any issues with the facility or whatever, please get a hold of Ben Hooper. He's right here. So I'd like to take a minute to recognize our sponsors. We have the town of Camp Verde, the city of Prescott, the town of Prescott Valley, the Prescott Valley Economic Development Foundation, the town of Wickenburg, the county, Yavapai County, Jennings and Strouss, and of course, the Regional Economic Development Center here at Yavapai College all sponsored the event, so if you wouldn't mind, let's give them a round of applause. Additionally, how about that lunch? Lunch was provided by the Caliber Companies, Palmer Development Group, and the Opportunity Zone Company. It's a great lunch. I hope you enjoyed it. So at this point, let me make sure I covered all the detail. I think I did. At this point, I'd like to invite up our moderator for today's activities from the city of Prescott, Economic Development, Wendy Bridges.
Well, good morning, everyone. Welcome to Prescott. We're so glad to have you here. I know some of you came from down in the valley and you braved this very chilly weather that we're having today. So if you want to take a snowball home with you, you can. We don't know really what to do with all the extra snow, so please avail yourself to that. So we have a great panel for you. Before we get started, actually, I'd like to ask each of the panelists to just tell us who you are and what you do.
Hi, everybody. My name is Brett Siglin. I'm a member at Jennings, Strouss, and Salmon in Phoenix. And we've set up a handful of opportunity funds over the last year, worked with some of the people in this room. We're doing deals down in the valley, also deals in northern Arizona and throughout the country. I come from a tax credit development and investment and syndication background. Started my career at HUD about 15 years ago, and I've been working the industry ever since on real estate, tax-motivated real estate deals.
Good morning, everyone. Brian Crum with Caliber Companies. We're a Scottsdale-based real estate investment development company. And when opportunity zones and opportunity funds were created, we looked at our existing business model and realized about half of everything we were doing was already in what became opportunity zones and would have met a lot of the criteria. So we made the decision last year to establish our own fund, which is actively making and seeking investments all across the entire state. And the thing that we're really looking forward to today is answering any questions that people have about some of the mystery of how do we make sure an opportunity zone fund works for our community.
Hi, I'm Adam Rutherford. I'm tax director at Schutte & Hogendorf here in Prescott. I'm working with a couple clients on opportunity funds and developing them. My expertise, if you want to call it that, on this is more of the compliance side of it, as far as IRS filings and reporting with them as well.
I'm Rob Witt, and I started the Opportunity Zone Development Company specifically to support investors or entities that are interested in developing in opportunity zones. And there's a huge opportunity to do that, and we're going to way overuse that word today. So.
Thank you. As I said, it's an incredible panel, and we're really excited about the content that they're going to be bringing you today. To kick it off, Brett has graciously offered to give us some background and overview on the Opportunity Zone. So Brett, would you like to start?
Thanks, Wendy. And thank you all for having us here. I think you probably all know by now that the Opportunity Zone incentive spawned from the Tax Cuts and Jobs Act of 2017. It had been through somewhat of legislative history prior to that. Several years before that, there was a congressional delegation that was hiking across Africa, and they joined Sean Parker of Napster fame, and the idea sort of spawned from that. It's very similar to prior incentives such as the Enterprise Zone Initiative, New Market Tax Credits, and the like. But there are some nuances and some interesting aspects of this that we'll talk about here today. The first thing that I wanted to cover was what exactly is a qualified opportunity zone. So a lot of folks here probably know this story by now, but generally it's got to be a low-income community, and that low-income community definition comes straight from the code under the New Market Tax Credit rules. It's under Section 45D, and generally it would be a community that has a poverty rate of at least 20%, or it's got medium family incomes that do not exceed 80% of the AMI. So what's interesting, though, is that not all low-income communities are qualified opportunity zones. There's also a provision that allows for adjacent communities that are contiguous to be designated as zones, and there's a handful of those here in Arizona. Nationwide, there were 8,700 opportunity zones selected over the course of the last year. There's over 200 in Arizona, and Governor Ducey was one of the first to announce last March. So what's interesting is a lot of folks really didn't know about this because it kind of snuck its way through the Tax Cuts and Jobs Act at the last minute in December of 2017. A lot of folks think that it was rather hastily written. A lot of mistakes were made. A lot of issues probably didn't have their chance to get fully vetted. So as a result, for a good part of 2018, we didn't have a whole lot of guidance. But back in October, we'll get into this in greater detail, Treasury announced initial proposed rules that were largely taxpayer favorable and answered a lot of questions. And as we'll get into, there's still a number of questions that need to be addressed. So let's talk a little bit about opportunity funds. So generally, if you're an investor or you're a taxpayer that has capital gain, you have every right to go out there and invest that money directly into qualified opportunity zone property. I'm sure there's folks out there doing this kind of thing, but for the most part, what's happening by and large over the last year is there's groups that are setting up qualified opportunity funds. And so the good news is it's really easy to form one. All you need is a partnership or a corporation. Treasury announced in the proposed regs that you can use an LLC so long as it's taxable as a partnership. You can use a REIT, you can use a RIC. So it's really easy to form an entity, and then there's a process that Adam will go over in greater detail later with me about how you actually qualify as an opportunity fund, and it's really not that hard. So what's more important probably is how, if I'm managing an opportunity fund, am I going to attract capital? So the objective obviously is to generate a return for my investors and to attract the investors in the first place. So I'd say one of the particular nuances in an opportunity fund is that I've got to attract investors that essentially are in it for the long term. They've got to have a long-term outlook of probably 10 years, and that's a little different from what's out there in the industry. If I'm really just managing a typical fund, I might only have a 3 to 5 year or 7 year outlook. So that's important, and then it's going to be really important for the fund manager to target investments that are going to generate cash flow, ideally as soon as possible and throughout the 10-year period. So let's talk a little bit about what the benefits are of investing in either a qualified opportunity zone or a qualified opportunity fund. So if I'm a taxpayer, and let's say I sold some Amazon stock last fall. I've got about $10 million in gain. well, there's different things I can do with that money. If I decide to park it in an opportunity fund, I'm going to get essentially 3 benefits. So the first one is a deferral of the gain. I won't recognize capital gain on that 10 million for at least up to 7 years. If I park it in a fund this year, I'll have until 2026 before there's any tax hit. And that's important for people to know. A lot of people miss that you're actually going to pay a tax on that original gain, and that's unfortunate, but that's just the rules of the fisc. So the second benefit is you're not going to pay a tax on the full 10 million. If I'm an investor and I hold it in a zone or I hold it in any fund for at least 5 years, I'm going to get at least a 10% reduction in the ultimate capital gain tax on that 10 million. And if I hold it for 7 years, I'm going to get a 15% reduction. So that's good news. So if I've got 10 million, I'm going to pay, at least 23% tax on 8.5 million, but it won't be until 2026. So there's some time value to that money. And also, the real nugget here for investors is not the deferral, but it's really the exclusion potential. And what happens is if I invest my 10 million into one of these funds, that after 10 years, if I hold that money in that fund or in any other fund, that I can actually take an exclusion from capital gain tax of the appreciated value. So let's walk through an example. And this is a really neat chart that we saw in Forbes magazine last fall that walks through sort of the differences hypothetically of what it might look like if I were to invest my money in a conventional fund that's earning 8% a year versus a qualified opportunity fund. So whether I'm in New York or Texas or California or Arizona, the bottom line is if I don't invest in an opportunity fund, I'm going to have a gain hit up front. And in some states it's going to be a lot higher than others, but in all states you're going to have a hit. And then after 10 years, I'm going to have a second recognition event. So if I've got 10 million today, it might grow to 15 or 20 million. But after those tax events, I'm only walking away with a fraction of that. Now, if I invest in an opportunity fund and it grows at the same rate and I've got an 8% return, I'm going to have that tax hit in 2026. That's going to cost me a little, but my money's going to be working for me over 10 years. And at the end of the 10 years, if I hold it in there, I'm going to have a lot left potentially. Let's talk a little bit about I'll just introduce some of the issues that we'll get into in much greater detail throughout this, but let's see. There it is. So one of the issues that came up last year before we had guidance was there's this concept of a 90% asset test requirement. If I own an opportunity fund, then if I directly own that fund, that fund directly owns real estate or any other property, then 90% of the assets of that fund are going to have to be qualified opportunity zone property. So if that's, if it's a single asset deal and it's in a zone, that's probably not going to be too hard to achieve. But the problem is the way the statute was written is that this test has to be satisfied essentially every 6 months, and even sooner. Let's say I form a fund and designate it on December 15th of last year. Hypothetically, I would have had to have 90% of my assets as qualified opportunity zone property by the end of the year, which would be impossible to do if I'm trying to develop real estate. So a lot of people out there were scratching their heads, how is this functionally going to work? There was some guidance in the new markets rules and the enterprise zone rules, and fortunately what happened is Treasury came out with what we're calling the working capital safe harbor. And this essentially gives us 31 months from the time, if I'm a fund manager, that I'm taking money from those that have capital gains. I've got 31 months essentially to get my act together and develop a project, and it works kind of similarly for other properties, but it's really meant so far for real estate. We're hoping to get further guidance that it would expand the safe harbor to any business. What it means is if I receive $10 million of capital gain in my fund, I won't have to satisfy the 90% test for at least 2.5 years. Now, to do that, I've got to have a plan, and I've got to have that plan in writing, and that plan better identify exactly what I'm planning to do, such as acquire certain property, who I'm going to pay, what architect's fees I'm going to have, what entitlements I'm going to have to spend money on, and then of course the construction project. And included in the plan, I need to have a schedule of my expenditures. It's got to be pretty well organized and thought through, and most importantly, at the end of the 2.5 years, that manager better stick with the plan. So the good news is this doesn't have to be reported, at least not so far. There's very few reporting requirements that are included in the initial proposed regs. We'll probably get more reporting requirements, but for now, it's important to just make sure that you keep this plan in your records. So there's some holes in this. One of the big ones is that the safe harbor doesn't necessarily work yet for non-real estate businesses. So there's a lot of folks out there that have been lobbying pretty hard in recent months to get this extended to other businesses that are originating or moving into opportunity zones. Another big hole that we've discovered in recent months, and a lot of accounting firms have been talking about, is that there's a direct investment approach and there's an indirect investment approach. So going back to this 90% rule, there's There's a new rule that applies for those that invest indirectly through a qualified opportunity zone business. So if I'm a fund manager, I can directly acquire the property and develop it that way, or I can set up an intermediary subsidiary partnership that's going to hold the asset, and it's got to be a partnership. It can't be a single member LLC. And if I do that, then that partnership will only have to hold 70% of its interest in qualified opportunity zone business property, and indirectly, the investors in the fund would only have 63% of their money invested in qualified opportunity zone business property. So this is a nice incentive that Treasury came out with in November. The problem is that if I don't want to use one of these subsidiaries, that I can't take advantage of that 70% asset test. And even more importantly, there's some question as to whether I can qualify for the working capital safe harbor. So these are a couple issues that we're hoping get worked out here. We all hope that by now we'd have additional guidance. If it wasn't for the government shutdown, we probably would have. In any event, we're hopeful to have guidance here in the next month or so. So the other big test and issue to consider with timing is substantial improvement of property. So if I'm acquiring a project or land, I've got a certain amount of time that I have to improve it or develop it. I've got 30 months. That's what's been clear from the proposed regs, which is nice. And there's a lot of folks out there lobbying for a longer period of time. But what this means now is if I set up my fund and I acquire some land or I acquire a project, I've got 30 months from the date of that acquisition to substantially improve the property. And what a substantial improvement means, if I spend $5 million to buy the project, I've got to put $5 million into the project. So if it's a land deal, that's probably pretty easy to do. The issue was that a lot of folks, especially on the coast, like to do AC rehab of existing buildings. So if I want to, buy a $10 million apartment complex and put maybe $15,000 to $20,000 per unit of work into it, that's not going to fly under this test. So what Treasury did after some pretty heavily lobbying last summer is they came out with a letter ruling that suggests that we don't have to include the cost or value of the land in the calculation if it's an existing building. So hypothetically, they gave an example where, let's say we have a $10 million building and 40% of its value is in the land and $6 million is in the building. I wouldn't have to put $10 million of substantial improvement over 30 months. I'd only have to put $6 million in. So that was a nice bonus for folks out there that might want to do an AC rehab deal. Now the problem is this is potentially ripe for abuse, because if you've got a huge parcel of land up north somewhere and it's got a few sheds on it, you might say, well, those sheds are only worth 50 grand and all I have to do is put 50 grand of work into it. Well, you might do that, but it's probably ripe for audit and abuse. So I would just say that it's important to have an appraisal to back up exactly what the value of the land is and the value of the building if you're going to be in this boat. And the closer you are to the 40-60 example that was in the letter ruling, probably the safer you are. I don't know how much time I have, but
you've got time for one more.
Okay, I'll talk briefly about what a qualified opportunity zone business is, and then we can sort of get the discussion going. But essentially, we've touched on this. A qualified opportunity fund would ultimately hold its interests in another entity, which would have to be a qualified opportunity zone business. And this can be a business that owns and manages real estate, or it can be almost any business. So the tests are almost identical in some respects, at least, to what a qualified active low-income community business has to be under the new markets rules. So essentially, substantially all of the tangible property owned or leased by the taxpayer has to be in the zone, qualified opportunity zone business property. The problem is we don't know what substantially all means. We're hoping to get guidance on that. It could be 70%, it could be 50%. We're not really sure yet. Another issue is if I've got a fleet of trucks and it's going back and forth across various communities, maybe some of them are in the zone and some of them aren't. How do you account for that? Another test is that if I'm a qualified opportunity zone business, a substantial portion of intangible property has to be used in the active conduct of a business in the zone. Again, this is probably not as relevant for a real estate deal, but if I've got a business and I've got IP rights and other intangible property, goodwill and whatnot, it might be hard to determine how I satisfy this test. We're hoping to get more guidance on that. Another rule is that at least 50% of the gross income has to be derived from the active conduct of a trade or business. And this one should be pretty easy to satisfy. One issue that's come up over the last 6 months or so is whether triple net leases would qualify. We're hopeful to get guidance here that they do so that people can do retail deals, but that's one of the issues that's been kicking around. And then the last component of what constitutes a qualified opportunity zone business is that less than 5% of the basis of the property can be non-qualified financial property. So this requirement was largely neutered by the working capital safe harbor, because essentially if you've got cash and cash equivalents for a certain period of time, then you'd run into trouble here. But as long as you satisfy that safe harbor and you actually improve a property, you're probably going to be in pretty good shape. So I'm going to skip the section on Treasury guidance. We've touched on a number of these rules. Adam and I will talk about it in greater detail later on, and we'll get into some of the issues that are yet to be resolved. But at this point, I didn't want to bore you anymore. I want to introduce some of the other experts here, and we're going to talk about how to raise money.
Thanks. Well, I don't know about you guys, but I have a lot of questions that popped into my head during his presentation. So if you do have questions yourself, we do have Dawn in the back with a microphone. If you just raise your hand and wait for her to come, she's in the back right there. She's raising her hand for us to show you how it's done. Do you have a question here? We already have a question over here. Mr. Chamberlain. Dawn is on her way. So if you have questions, just raise your hand. We do need it to be on the mic because it's being videotaped.
Wendy, on your Prescott Opportunity Zone map here,
Yes.
is this going to be expanded, or is this it in terms of what's going to be available in the city of Prescott itself?
That is the entire zone. We have one census tract in Prescott, and part of our presentation later will be going over each of the opportunity zones in Yavapai County in greater detail, but that is the entirety of Prescott's opportunity zone.
The entire?
Yes, sir. So my question that was going through my head during your presentation was, who would invest in a fund? And I feel like, Rob, maybe you could help us answer that question.
Well, I think we're all going to answer that question, but I wanted to take everybody through an illustration. Hopefully we can put a handle on it that will help. But before I get there, I wanted to start by talking about opportunity zones just a little bit. And right now at the Camp Verde Elementary and Middle School, there's 800 students there, and 70% of those students qualify for the free lunch program. So that means there's 560 students eating free lunch at the campus because of their income levels. Now, in this group, I believe that every single person here realizes that somebody's actually paying for that lunch. It's not really free. So if you look around and look at the tables across from you and you realize you're probably sitting across from a taxpayer, you recognize that you are paying for that lunch. And so from that standpoint, this particular program is not that different from that. I hear a lot of people say, oh, there's all these really great benefits, but there's a cost to those benefits. And if you have a piece of land or if you have a property that you think all of a sudden it went up and has this tremendous value just because it's in an opportunity zone, you're kind of like the kid that thinks that nobody's paying for his lunch. Because there is significant strings, and Brett was really smooth on that, but there's a lot of things that you have to do to qualify to do a project inside of a zone. And so from that standpoint, if you're willing to put up with all the strings and put up all the federal requirements, it's a phenomenal program, and it has unbelievable benefits. But there really are a lot of compliance issues, even though they're saying that they're not. I don't know if I'd accept that. So our illustration, Mary Smith is not a typical real estate broker. She's a pretty wealthy broker in Florida. She got her license in 2003, and since then she's bought a couple of RV parks. And the day that she closed her first deal in 2003, it was December 20th. She was a little unusual. She didn't go buy a car. She bought 1,000 shares of Apple stock. Anybody buy Apple stock in December of 2003? $1 a share. Since then, in 2005, it did a 2-for-1 split. In 2007, it did a 7-for-1 split. She now owns 14,000 shares. At closing price on January 21st, 2019, the valuation of that stock was $2,351,000. Pretty nice gain. So $2,350,000 of that is a capital gain. So this is an opportunity for Mary Smith to say, okay, what am I going to do with my money? This asset class is a pretty wealthy asset class. The majority of the investors are really concerned about preservation of wealth. So it's a primary thing. They're not out there taking risk. They're older as a rule, and a lot of them are interested in putting money where they're not having to manage it, which is where Brian's firm comes in. They do a great job managing, but a lot of them want to control their assets. I've got a client who sold his business for $8 million, has an $8 million gain, and does not want to give it up for 10 years. He wants to in some way control it. And so this is kind of a discussion about that. So Mary has this gain, and if Mary is in, and Adam's going to address this a little bit later, if Mary is in a 36% tax bracket, that means she's also paying 23% capital gains. Now, our tax brackets are a little bit more complex than they used to be, so they're going to talk about that a little bit, but we're going to make the assumption that she is. So in this particular instant, she has about a $400,000 tax bill that she'll have to pay if she chooses just to pay the taxes. And so there's a decent amount of money that she can borrow from the federal government for 8 years. So Brett's going to talk a little bit about this structure, but Mary has some decisions to make. One of the decisions is, does she want to manage it herself? And the other decision she's going to have to make is, if she doesn't want to manage it herself, she's going to have to do a number of different things. And so structurally, one of the things that she probably needs to do is talk to firms like Brian's and find out, okay, what will they do for me? What's the cost of that? And what are the benefits of that? And they're pretty substantial, because there are a lot of things that are going to have to be done if she ends up hiring somebody like Dan and I to run her projects, and it'll be very difficult not to. Now, one of the things that you have to do is you have to keep a project for 10 years, and so there really needs to be a focus on management. It's not like you're going to flip something in 6 months. So you got to think through who's going to manage it, and are they going to manage my wealth and manage it correctly? Now, in Mary's case, she already owned 2 RV parks. And so this is an opportunity for her to potentially end up with 3 RV parks. The management, in that case, is not going to be that difficult for her because she's just adding to her business and then taking it and putting it in a zone and getting a tremendous amount of tax benefits. One of the biggest one will be in 10 years when she doesn't have to recognize the gain. So in terms of the structure, her attorneys are going to advise her, but the structure, odds are, is going to be for her to form 2 businesses. The Opportunity Zone Fund, which she will run, and the Opportunity Zone Business, which she will have to have at least 1 partner in because it has to be a pass-through entity. So Brett's going to talk about that a little bit later, but there's specific reasons for that. But what that is going to look like is when she puts the money in the Opportunity Zone Fund, she's got these requirements that are 90% requirements that she has to have a qualified asset in that particular fund. Now, the definition that, in terms of qualified asset actually comes back to original use. And so this is where we run into issues with real estate, because honestly, if you buy real estate, are you really the original user? The answer to that is no, never. Somebody was using that before you did. So what's happening is you're essentially violating the original use requirements of the statute. So the way that the guidelines have come across is the way that we do that. That's where we have to do the substantial improvement. So we have to substantially improve the property, and we have time frames that has to be done. So the fund will have that 90% test that they will have to go through on the 30th or the 31st of December and on the 30th of June. So you got this coming up every 6 months, like clockwork. And so you have to be able to manage that. And so if you take the money and you put the money in the business, that's when you can qualify both the asset that you purchased and the plan will qualify the cash that's in there. And so it becomes good assets for the fund. And so that's just that same slide. So in terms of the things that Mary is going to have to do to qualify her project, really the biggest thing is it actually has to be shovel ready. So she can't go and tie up a piece of property and then start improving it in a year and a half or 2 years. So the normal entitlement process of going through and getting your zoning and designing the project and getting all your plans approved, getting all of your will serve letters from all of the utilities, making sure you've got access. You don't have time to do all of those things. And so you really have to have projects that have a lot of that done for you, or you're not going to be able to do it in an opportunity zone. This is a copy of an actual due diligence letter that I had Granite Basin do for me on a 300-unit apartment complex I'm using. This, and I'm not going to read through all these things because it doesn't matter all of those things are, but I asked him to identify all of the things on this particular project that could stop it from happening. So this is the first page, there's the second page, there's the third page. These are all of the things that Granite Basin Engineering determined on this particular site that could stop it from being completed within 30 months. So if that happens, that would disqualify all of the funds and all of the tax benefits would be lost. And so for that reason, somebody cannot afford to invest in a property and have all of the things already ready to be completed at the time they closed. So really a project that is shovel ready, which means all entitlements are done, all will serve letters are done, all of the review is done of your construction plans, your contractor has bid it out, you have numbers, then you put those numbers in your plan, you put the property in the business, you put the money to complete the improvements in the business, and you put the plan to cover those in the business. And that's what the process is. So that was a lot real fast, but that's what we want to talk about, and there's a whole bunch of things we can contribute, and I'm thinking we're all going to go back to that illustration and talk about a number of things in there. So.
That was a great opportunity for Mary Smith to buy that stock when she did. Is everyone else wishing they had a time machine? Did any of our other panelists want to tag on to any of that?
So I'll jump in real quick from a development perspective. I think the development is the same process that you typically go through, whether it's in an opportunity zone or not. The difference is, like everybody mentioned, timing. It makes it more complex. It's not a gift from God that you buy a property in an opportunity zone and you're suddenly going to make a lot of money. It's more complex. The time frame shrinks down significantly. You have a lot more reporting requirements, and you have a lot more pressure. But when you substantially improve land, you can do that with site work. If you buy a piece of land and you throw in your horizontal improvements, you can get most of the way there, maybe a building. So that would probably maintain your tax treatment, and I think that's key, especially when you're inviting in investors and promising them tax benefits. You have to hit these timelines. So timing is the most critical path, and I agree. I think that having it shovel ready and having as much done up front before you close is very critical. If anything, this makes it more complicated, but for your investors and your capital, if everything gets done, and there's a big if in that sentence, everything gets done correctly, you can really enhance the gains for everybody.
Are there any other strategies you would suggest to help protect the investors?
Well, it really needs to be almost like a public-private partnership for a lot of the municipalities that are in the room that have planning departments and economic development departments, for them to be somewhat conscious of the developer and the investor's time frame. I know a lot of municipalities have expedited review that you can pay additional permit fees for and benefit from, but if you're going through a 1.5 year entitlement process, that eats up about half of your clock. So it's important for municipalities and developers to work together in a collaborative effort to create an environment where you can hit these timeframes.
I'm glad you mentioned that, because when I first heard about the opportunity zones, being an economic developer for the city of Prescott, my first question was, what will our city's role be in the opportunity zone, which is why I invited our community development director to join us today, because the timing does seem to be the place that the communities can really help make these projects work.
I agree. It's a huge benefit to have that collaborative effort, and to have not only a collaborative effort inside the municipality. So economic development should be working with planning and the planners on the staff level to help try to, I guess, speed up the process internally for these particular zones that they want to see improved in their municipalities. If there's an area that the city wants to attract capital to redevelop, to enhance, maybe you have a specific protocol specifically for these properties within this zone. And maybe it's as simple as waiving your expedited fees or something like that to help. And if you can create that collaborative effort inside the municipalities and the developer is communicating effectively, again, everything's all communication with these things, but if everybody's communicating effectively and working as a team to accomplish these goals, it can have huge benefits for municipalities, for communities, and for the investors and ultimately the tenants and the developer at the end of the day.
That's great. Did anyone else from our panel want to tag on anything there?
I wanted to add one thing to that too. I sold one of my properties to a Opportunity Zone fund, and that would not have happened if it weren't for the Community Development Department at Camp Verde. It was the third property that they purchased in our Opportunity Zone, and honestly, they liked the Community Development Department so much that they were willing to look for other projects there, and they took a little bit more risk on my project than they did, even though we did a tremendous number of things. They actually, on my project that I sold to them, don't have all of the entitlements that they had on the first two. And that was because they had a trust level with the Community Development Department and felt like, you know what, we can go ahead and do this here and they're going to take care of us. And that never would have happened if they hadn't have demonstrated that, you know, they really were there for them and recognized they had time frames. And so I just wanted to really acknowledge their hard work and how important that was for that process for us. So.
And if you have a piece of real estate that's in an opportunity zone and you're in the room today trying to understand how that benefits you as a potential seller, it's going to be very difficult for you to do a 30-day escrow on that sale. You're going to have to work with your buyer to allow him to have enough runway to get as much done up front as well, so that when he does close, he has, again, he has as much runway as possible to improve the property and maintain his tax treatment. At the end of the day, does it increase the value of your land? I think that's still out, but at the same time, you got to be cognizant of your buyer's timeline. And a lot of people want quick closes. They want a 30-day close or a 30-day due diligence and a 30-day close. That's going to be difficult, I think, for a buyer to hit those timelines with a quick close like that. And I'm sure you had to work with your buyer and give them a lot of latitude on a lot of that huge laundry list of items. So from a seller's perspective, it can be cumbersome, and I think you got to give up some of the benefits of a quick close. But at the end of the day, it's an attractive to a lot of investors.
We have a question right there.
Hi, Scott Fagan from Foothills Bank. So who ultimately signs off on, when you look at the timeline of a project, who signs off on completion? Is it designated by a C of O after the completion of the project? And what kind of jeopardy are the funds in if there was a delay due to construction?
So the question is, who signs off on completion of a project? And how, sure. Well, over the 30 months, it's C of O would certainly be the best evidence, but I think the other test would be that if I've got 10 million that's been invested into the fund, if I've expended all that money and I've substantially improved the property by more than $1 for dollar, then I will have satisfied that test.
Can you do that through appraisals? Appraisal at the time.
That's a good point.
And then
Yeah.
another appraisal when you substantially.
Yeah, you could do an appraisal at that point, and then another point at which you'd probably want to do an appraisal would be, say, close to year 7, when you're going to be having to deal with the tax hit that your investors face. There's probably going to be a lot of appraisals at that point in time, and those will probably be undervaluing the asset because each of the investors is going to take some kind of lack of marketability discount, minority discount, and that sort of thing. But it's interesting. There's going to be appraisals at completion. There's going to be appraisals when that tax hit comes or when you want to refinance. And then potentially at the end of the 10 years, there's going to have to be appraisals to determine what the fair market value of those interests are on the exit.
So you're really trying to defend an audit, right? So you want to build a file so that in 7 years or 10 years, if you're audited, that you're able to demonstrate to the IRS that you maintained and hit all these protocols.
So to be clear, you're going to do an appraisal as completed to start the project. You're going to do an appraisal once it's completed and once you get C of O to create the trail that you've qualified it. So my question that I tagged on to that is, what happens if at that 30-month period you get an appraisal and you're not dollar for dollar, you've come in short? Are you disqualified from the program at that point, or is there a way to stay qualified?
Yeah, I mean, it's unclear at this point. It's probably likely that Treasury will allow for some leeway. The 30-month period is not necessarily set in stone. That's what they proposed in the initial guidance. There's a lot of folks out there lobbying for additional time if needed for acts of force majeure, potentially if you have issues getting zoning and approvals and permits and that sort of thing. So that's yet to be determined. But yeah, I mean, Adam, do you want to talk about penalties?
I mean, well, the 90%, as far as the 90% test, it's possible that asset would no longer be qualified, and so then you wouldn't be able to hit that 90% test, which we'll get into the kind of the penalties and how they're calculated on that here in a minute. But if that property or the cash that you're holding for that isn't spent on it, then I mean, like you said, we're waiting on guidance on that, but assuming that doesn't qualify anymore, that's where you're going to get hit, is that 90% test.
I think if you spend the money, you're fine, though. I don't think you have to get an appraisal. So if you put the plan in place and the plan is covering the money that you've set aside to spend it, and then you spend it, I don't think it matters what it appraises for. You did what you said you were going to do. So that's the most important
and
thing.
the other protection out there for investors is if I've parked my funds in a fund, my gain, and it's a dog, and this manager isn't doing his job, I can still back out. It was actually proposed in the regs that investors can sell their interest in the fund within the 10-year period, but then they've got to reinvest those proceeds within 6 months. So the problem with that is potentially the 10-year holding period would start again. That's not necessarily clear at this point, but you're not necessarily going to be penalized because your fund manager isn't doing their job or because there's just circumstances that made this project unfeasible.
And part of the reason he mentioned all the appraisals needed in 2026 or 7 years is because the gain you recognize, 85% that's left that you recognize in 2026, it's the lesser of your original gain or the fair market value of that property or your unrealized gain on that investment. So if the investment has dropped in value, you don't have as much gain to recognize in 2026. Of course, that's not the goal, but it's an option.
So another issue that comes up a lot is people ask, well, will I be able to take cash out, or will there be distributions of cash if the project does really well? And most people would say that yes, you can do that. So far the guidance has been favorable in that respect. I think it'll be clear in a month or two. But I guess the thing to know is that if I'm an investor in a fund and there's cash coming out to me, I'm going to have an ordinary income tax event on that, but it isn't going to trigger gain that disqualifies me from getting the exclusion at the end of 10 years.
Does that answer your question? Yes, okay, good. Are there any other questions before? Yeah, oh, we've got some questions over here.
Okay, we need it for the video.
No, I think it'll be okay.
How many Marys do we have in here? That's a great story. My name's Bob Broyles with Colliers International. I'm an investment real estate broker, Phoenix and here. My question is, how long does, after Mary sold her stock in January, does she have to make a decision to invest into an opportunity fund to defer the capital gains?
180 days if she's selling stock. So if she sells her stock, say November 1st, she would have 180 days until whatever that is, I guess May 1st of this year. Now what's interesting is Treasury came out with a rule that's very favorable if Mary were a partner in a partnership and that partnership sold property, say in February of 2018, Mary wouldn't technically have to recognize that until December 31st of 2018, and she'd have the election to either take the 6 months from February or to wait until December 31st. So it's a nice bonus if Mary's a partner. It buys her a little more time, but otherwise it's 180 days, and we'll talk a little bit more about how that's kind of similar to the 1031 exchange requirements. There's other similarities, and then there's some other things that are quite different.
So same for real estate. She sold stock, but same in real estate?
Same for real estate, same for really any gain, collectibles.
Okay, great. Thank you.
It actually works really good with stocks because when you have a portfolio of equities, you have a lot of control over that taxable event. When do you sell? So it allows you a lot more flexibility with the timing, right? So you can wait to pull the trigger on the sale of that stock, and you have a lot more control as opposed to selling a business with an escrow period or selling another piece of real estate. If you have investors that have stocks or equities, it's a lot easier.
Okay, we've got another question.
Well, greetings. Appreciate you all coming out here. I'm John from Smoley from NRL Mortgage out of Camp Verde. And I've been listening to what y'all been saying here, and I'm putting myself as an investor, you know, that's how you sell it, you know, to anybody else. And one of the things that's kind of troubling me is the squeeze of the time frame. You're all talking 6 months, 12 months. Say for example, you had a large real estate profit, and you're getting squeezed from IRS to reinvest at a certain amount of time, and then you have the squeeze on the other end of getting all these ducks in a row. You're like Robert had all your 3 pages of things, you know, that you don't get that done overnight. So now I've got this, you know, several $1 million I want to park into a project, and if things don't go right, this all blows up my face, and I get, you know, coming and going here. So is there one thing that came to my mind was you could type a property with an option, but then you got to spend a lot of money on doing all these surveys and things, and on a maybe, but then you still have the time problem, on that. Maybe you could park it, and if you're a real estate investor, through a 1031, get your deferment, and then once all the ducks in a row on the forward end are done, then you can unload the other 1031 you just did, and then move those funds into something that's, quote, shovel ready. So I'm trying to think of ideas like that, or what y'all, because I'm seeing getting squeezed on a two front war, like our World War II or something with the Germans. So you've been pushed from one end and you got a brick wall on the other. So like a little help on that one there. Thank you.
Actually, that's one of the biggest reasons why it's tricky. The time frames are significant, and the best description I've heard of it is that the IRS is really not going to care until all of a sudden 10 years down the road we have a $5 million gain that we're trying to not pay taxes on. And then they're going to audit us for 10 years and make sure we complied with all of the rules. So from that standpoint, it is tough. Now, really the best advice I could give anybody is you got to plan. And so that's why stock is just a great thing. You really need to find the investment that you're going to roll it into. As the funds grow and as Caliber's fund grows, it's going to be easier and easier for them to bring in large amounts of capital because they're going to have that 10% amount that they can have in cash. And so if they have $1 billion fund, that means they can have $100 million in cash in that fund and not have a lot of pressure to invest it. And so, that's going to be beneficial for the big funds and there's going to be reasons why people are going to invest in the big funds over time. Now, one of the things that I'm seeing is in this asset class, we have an awful lot of people who want to control their own destiny. And so they kind of just don't want to give up the control of their money for 10 years. And so they want to form their own funds and control those. And so from that standpoint, it is a challenge. And honestly, you do have to plan it out. You have to say, I don't think you should close then, because you need to identify the property and what you're going to do with it and get the plan ready before you close, especially if you end up closing and having to invest the money within 3 or 4 days. And I've got one story that actually relates really well to this. I was in Chris Leffler's office, who was the founder of Caliber Funds, on December 10th of this year, and he just got off the phone with a businessman who had sold his company 177 days before this conversation, and he had a $45 million gain. And so he asked Chris, can I put the money in your fund? And Chris is a CPA and he's really good at counting. And so if Chris was going to accept that $45 million on December 10th, he would have to figure out how to use 90% of it by December 31st. So it was not possible for him to do that. And so that just needs to all back up to where on both sides. So if we're talking about, okay, how do we find investors? Well, the first thing we need to do is get our project ready to go. And we need to make sure that we're actually going to be able to meet the time frames, and there's integrity in that process. And then the next thing is that as we talk to people, we encourage them to manage the process from their standpoint. They need to understand that there's time frames are going to start, and those are going to start when they recognize their gain. And so the more time we can buy ourselves between when they know they want to do it and when those time frames actually start, the better off we are.
So another approach to take possibly to have more control over the timing is if I'm the fund manager and I'm developing my own properties, and if I've got fewer properties to develop, it's going to be a lot simpler. So a lot of our clients are really doing single asset deals, especially while some of the rules are still yet to be finally determined. But it does give you more control over the timing and the predictability, and then hopefully, it's less complicated on the management side as well.
Okay, and we have another question over there.
Carol Benedict with US Vets. I'm wondering, can these investment funds be combined with other tax incentives like LIHTC?
Yes, they can. I haven't talked to anyone that's figured out exactly how to do it with LIHTC. The issue with LIHTC is that the syndicator is funding 99.99% of the capital. So if I'm the sponsor of a LIHTC deal, especially if it's a 9% deal, the capital obligation is so small that it really probably wouldn't be worth the headache. I mean, you could certainly do it and raise $10,000 or whatever it is you need. But whatever pre-development and pre-acquisition costs you have in a LIHTC deal, you're generally getting those back at the closing with your investor. So the issue then is, will the investor want to do this? And I know PNC and a few other of the bigger national syndicators have been looking into this. Enterprise is another one. As far as I know, they haven't figured out quite yet just how to do that. And I think one of the big problems is the ultimate investors in LIHTC deals are banks, and they tend to be much more conservative. And these rules are still, not yet finalized. The investor that we're talking about, lo and behold, like these gentlemen have mentioned, are people that are selling stock. So there's folks out there saying there's $6 trillion of potential capital gain. It's from anywhere from 2 to 6 trillion over the next few years. And those are largely high net worth individuals that wouldn't otherwise invest in a real estate fund.
They wouldn't sell their stock.
Right, right. So it's a little bit of a Wild West phenomena. It's more similar to what LIHTC was like 30 years ago. That said, a lot of people think that this program would combine well with new markets tax credits, and it could certainly combine with historic tax credits.
Yeah, I've seen some interesting business models where, because it doesn't work directly with LIHTC, it does work well if you have a LIHTC project and then next to it they do a new market tax credit that brings in some sort of a community-based healthcare component, as well as maybe helping fund like an incubator that can help people start their own businesses and create some sustainability in their lives so that they can move out of that low-income housing situation and become sustainable. So we are seeing situations where you could do an equity investment from an opportunity fund in conjunction with the new market tax credit program. And then, because a lot of people in the room are involved directly in economic development, it's also really important for you to understand what are the other types of resources available either at the state, local, or federal level that you can use to make sure that if you're attracting a developer, and I'll use the example of a new office building. So let's say you're going to develop a brand new office building in an opportunity zone in the efforts to attract new companies to come into your city or to expand. Make sure that you're working with them in conjunction with all the different other resources, tax credit programs, as well as partnering with companies like Caliber that can come in, fund the project, and then also develop it.
Did we have any other questions? One more over here. Boy, Dawn's getting her exercise today. I hope you have a step counter on. Oh, good, she does.
Good afternoon. I'm Connie Contelme with Keswick Construction. I was kind of concerned with exactly what you were just mentioning. Are you finding now in these groups that are developing in the opportunity zones that they would have, for example, a cache of blueprints that would apply? Because I can't imagine just in the design process getting through the time constraints. How would you develop maybe 150 units of condos and start from conception on up and meet these time frames? So do you have developers that are joining into these groups that are providing ready blueprints that could be adopted or adapted to some of these lots? Oh, and one more question. How would this is completely different. How would a self-directed IRA fit into this puzzle?
Go ahead, do you want to go?
I'll make that one really simple. Because there's no capital gain that would be attributed to it, this is going to be used for non-qualified money. That being said, you could potentially take other non-opportunity fund money as part of the capital stack for an investment. So we at Caliber, as an example, we have our opportunity fund, and if there's extra equity available for other funds to invest into it, you could theoretically use qualified money from a self-directed IRA, as an example, as an additional investment in the same project. You're not going to get any of the tax benefits, but you're going to get the investment experience.
For your first question, in my experience, for a project I'm working on right now, it's already entitled, it already has its zoning. While I was in escrow, I submitted my DRC package to the community. And once I got my first round of comments from my DRC package, I went at risk on construction drawings. My goal is to try to get under construction within 9 months to a year from the acquisition, so then I have another year and a half, so to speak, to make the improvements. That gives me a little bit of cushion and time frame to make up for any delays or mistakes. But you do go at risk a little bit to try to shrink down that timeline, but you want to try to get as much done up front. I don't know if I would attempt any of these projects with something that needed to be entitled or rezoned.
Okay.
Dan said a couple things that I think are really valuable in terms of the process. And I want to back up a little bit to the question of self-directed IRA. There are things that have to be done to reduce the risk for the funds. That's where I think the self-directed IRA comes in, because there's really not a reason to invest money from an entity that already is not paying taxes into an entity that's not going to have to pay taxes. But that being said, with a self-directed IRA, you can do the things that are necessary to prepare a piece of property for the fund to be able to invest in them, because you don't have those same timing issues with your self-directed IRA. And so you can pay for the feasibility studies, you can pay for the entitlements to be done. And so all of that stuff has value, and it will have value to the fund. And so you can pay your self-directed IRA a return that won't have a negative impact on the fund who will ultimately buy it and need those things done. And so there's definitely room for both investments in the process. But the most important thing to reduce or minimize the risk for the fund is to get it ready, so there's just not going to be one of the many things that can happen to actually stop a project from being done. And if it stops and it's not completed, if you've got a big fund and that asset all of a sudden becomes non-qualifying for that fund, and that drops them below the ratio, every investor in that fund risks being able to get the benefits. And so it's not something that somebody can take lightly. I mean, it's things that have to be done. So.
Connie, you need to be on the mic. She's coming. There you go.
Sorry about that. Would you suggest then forming an LLC inside of the self-directed?
I have my self-directed IRA is managed through Vantage, and then I have an IRA LLC. So I have to send my money to Vantage, and then Vantage then invests in my LLC, and then I run my LLC however I want, and then I just have to report back to Vantage every year. So,
but you could also invest in a REIT, correct?
Sure. Yeah, absolutely.
So we talked about what is an example of an investor. We talked about Mary. She sold some real estate and she sold some stock. What we're also experiencing at Caliber is that the majority of our investors are not people that have actually sold either stock or real estate. Part of the reason for that is a 1031 still works really well in the situation for a lot of real estate deals. So until someone determines that an opportunity fund is a better investment opportunity for them than a 1031, they may still continue to go that route. What we are experiencing are people selling their businesses. There's a lot of private equity money out there that's out there buying up the $5, $50, $100 million plus companies. They may have been in families for generations. So we're experiencing that. And then we're also seeing people that are successful entrepreneurs. They're receiving VC investments into their companies, and they're experiencing significant capital gains. So there's a lot of different scenarios other than just stock and real estate of these extremely large capital gain events that then get invested into opportunity zone funds. One of the other things we wanted to cover, we've been talking a lot about what happens with ACE for single project and what happens if it doesn't work out and what are the penalties for that. So one of the ways that Caliber is going around or going about getting around that is we're doing a diversified multi-asset fund. So at this point we have several investments in the fund. Eventually, over the course of the next 5 to 10 years, it's very likely we could have somewhere between 20 and 50 different investments. So now if we have a couple projects in there that end up not meeting all the qualifications, we don't actually run into a penalty situation for our investors. So not only are they diversified by geography and by asset class, we're also making sure that between proper due diligence and having the right infrastructure in place, and then having a little bit of wiggle room, like you mentioned with the 10% situation. So that's one of the reasons we think that an investment into a multi-asset diversified fund like Caliber's could be a pretty good opportunity. One of the other things we want to make sure we cover in this particular venue is how people in the community, whether you're a business owner, a landowner, an economic developer, someone that wants to make sure that their community takes full advantage of an opportunity zone and then the opportunity funds. So what you need to do is take a look at what are the needs within our community. You know, are we trying to attract hotels? Are we trying to attract more office buildings so that we can create jobs? Are we in an area where it's suitable for industrial and manufacturing? Do we need more affordable housing? Do we need market rate housing? You know, what are the actual needs of our community? And then once you've identified that, then there is a way that you can take that message and get it in front of either people in your community that are establishing their own funds because they want to control the project, they want to make sure that that money stays in their own community, or to make sure that that investment is known and attractive to funds like Caliber's or even some of the larger national funds that have been established. And every 6 months, they have to make sure that they put money that has been invested into their fund directly into a qualifying project. So, you know, one of the things that we wanted to make sure people understand is even though Caliber's current investments are related to hospitality, multifamily, single-family rental communities, we're also looking at what does each individual community need. And if someone says, hey, we need to have more workforce housing, or there's a shortage of student housing near a community college, then once you've identified what your community needs in an opportunity zone, now you need to make sure that, as we talked about with the 30-month rule, what do we need to do to make sure that we meet all those timelines? Make sure that everyone involved in your community, whether it's the city council, planning and zoning, you know, the people that most actively engaged in it are typically economic development, and they need to make sure that all those communications are happening so that if you do bring an opportunity fund investor in, whether it's someone in your local community or a large national firm, that you're going to stand out and then meet all of these different requirements.
Okay, that's a lot of information. I've been furiously taking notes up here because I'm learning a lot too. I would like to talk a little bit about issues and obstacles that are specific to managing a fund. So Brian, you may be best to answer this, but anyone on the panel, please jump in.
So I think part of it we talked about just making sure that you're meeting all of these different requirements. And one of the ways that you do that, whether you're establishing your own fund, making sure you're working with people like Rob and Adam and Brett, who have been intimately involved in this process from the very beginning. So any of the rules that we don't know now, we do anticipate that those clarifications are going to be coming out of Washington at some point in the next few months. Once that occurs, now it's a matter of making sure that you are meeting all those different requirements. And in our case, one of the biggest concerns that people originally had was, well, how are you going to make sure that you continue enough deal flow? What we're experiencing, because if someone right now would Google Opportunity Zone Fund, there's a very good chance that they're going to come across our website. What that means is we're literally seeing 5 to 10 new deals being submitted per day. We had to hire people. We hired an accounting team. We have a whole due diligence process that goes through an intake process before we even know whether or not that's something that we move forward with. So in our case, Rob mentioned that we couldn't take in $45 million with 2 weeks to go in December. Today, that would probably be an entirely different story because we probably have several $1 billion of projects in underwriting. So that's one of the challenges, making sure that you're lining up the timing of incoming capital, because if it's not tied to the sale of stock, you don't have as much time control over it. Because there's a long time frame of selling a business, we need to make sure that if someone tells us, hey, my 180 days is going to be up in September of this year, we want to make sure that if that's a pretty firm commitment, that we've got a qualifying project on the back end of it, or that we can use additional new cash to go into an existing project that we have until it gets to a level of completion.
That makes sense. Do you think that, for example, here in Prescott, one of our target industries right now is the technological industry. Now, they don't actually have a tangible product. So would they be benefiting on the VC side? I mean, where would a company like that be able to benefit in an opportunity zone?
So because the initial thought of this program was specifically meant to help fund and grow tech companies. So as an example, Sean Parker's like, hey, wouldn't it be great if we could take money of other companies like Facebook and use it to reinvest into other tech companies, specifically in areas that are not receiving those types of investments? Right now, there's still enough uncertainty about investing in a tech company because of the origin of where the revenues are coming from that I personally haven't seen that happen yet, but there are a couple different ways that they could potentially benefit as we wait for that next level of guidance. So one, an opportunity fund investor could be creative in the structure of their lease. So as an example, Caliber does have some technology tenants potentially lined up for one of our existing opportunity zone investments, which includes some mixed use, retail and office. We could potentially be very favorable in the structure of our lease because this is long-term money. I can have a couple years up front of substantially reduced lease terms if I know on the back end, 10 years from now, I'm going to have a really well-occupied office building. So you could be really creative in the structure of the lease. The other thing is there are a lot more VCs specifically looking for investments not on the coasts. And one of the benefits of Arizona is we've been able to find out how to attract that money, but the local entrepreneur may not know. So make sure they're reaching out to Arizona Commerce Authority as an example. I personally would be more than happy to show them how we've received funding for some tech companies that we've been involved with, helping start and support as well.
Okay, and also if you know those companies looking to invest, you can also give them my name and number as well. Might as well invest in Prescott. And just in case you didn't notice, I have been advised that the temperature issue is being addressed. So if you're too hot or too cold, they're working that out. So, but let's keep, speaking of hot, this topic is so hot, right? Let's keep going. I would like to maybe touch a little bit about how a nonprofit may factor in. We've had a lot of questions in our community. Is there an advantage for an opportunity zone for a nonprofit, and what does that look like?
I think there is, and I want to talk just a little bit about, we keep talking about guidance, and if you don't know what that means, and I didn't for a long time, the bill is 6 pages long in a huge bill that, how many pages is the whole bill, Brad? It's really long. So we got 6 pages, and then we get nothing official interpreting that bill until October 19th. The initial bill was signed by the president December 22nd, 2017. So then we go along, we come to October 19th, and the Treasury issued proposed rules in a 90-day review period. So that should have ended in December, the review period. Well, the government was shut down, and so that didn't end. And then I guess February 14th they had another meeting, but still haven't really addressed making any guidance permanent. So all the things that we're talking about is the best we can do in terms of what we believe is going to be happening. And so now that being said, nonprofits. I believe over time there's going to be vehicles that are going to be produced by our creative legal minds that are going to be very powerful in this. And so if someone has already committed, for instance, if someone wants to make a significant contribution that is coming from a capital gain to Yavapai Medical Center, for example, and instead of making that gain, that donation directly to the medical center, if they make that donation similar to a charitable remainder trust, but make that donation through an Opportunity Zone fund, and then end up having the benefits of the Opportunity Zone fund after 10 years when it's run its cycle, then going to the whatever the nonprofit is, you're stacking those benefits. And so what ends up happening is there's a greater amount of resources because it ran through that filter, and then the nonprofit ends up with more. And so then if you have a series of donors that want to support a specific nonprofit that is already in a zone, this is where it really opens it up significantly, because there's no reason why those donors can't contribute their capital gains into a fund that is specifically designated to, let's say, build an addition to a hospital. And so then they're contributing it there. They're getting all the benefits that come from running through the zone. And then when they ultimately contribute it to the hospital, they get all of the benefits of that donation. So they get the Opportunity Zone benefits up front, and then they get the charitable donation in the end after 10 years. And so
Two other strategies, too, that a nonprofit could utilize would be potentially to contribute land into a fund, or potentially to be used as a bank and provide low-interest financing. And that might be done even through a CDE combined with a new market tax credit deal. One of the things that we haven't touched on yet that people should know is that it's definitely cool to leverage. A few months ago, there were questions about whether a fund can borrow money, but the guidance so far is pretty clear that you can go out and leverage as much as. You want to talk about
that? Well, you want to stack debt on top of your equity, which is being deferred because it's cheaper money. So you most likely typically have 40, 50, 60% equity. Well, at least I do. Some people do 30% equity. It's a little bit more risky. That's really the equity that you're raising that's going to experience that deferred tax. And then after that, once we either hit a pre-leasing requirement or we pull our construction loans, typically that's done with debt. And so you're stacking this equity with debt, and it creates a good mechanism to get these projects developed.
Yeah.
So yeah, you can borrow money on top of this.
Yeah, there's a couple examples of nonprofits that have a for-profit entity. So they're combining these together, and the for-profit entity is able to utilize an Opportunity Zone fund as an investor. There's also an active working group that was established by the Arizona Commerce Authority, and there are examples of how nonprofits can participate that we're working through the different business models. The Arizona Commerce Authority will be sharing that information with people. There's a website that's being established. If anyone wants to learn more about that, make sure that you stay in touch with me. We did put flyers on the middle of each table for caliber companies. That's also used so that you can stay in touch with us related to any of these types of questions related to Opportunity Zones. And the one about how do we help grow nonprofits is one that is really a hot topic across the whole country. And there's definitely a lot of ways that it can be structured. We just need to see a few examples worked through. And because we're literally, 2 months into 2019, I think at some point in the next 6 to 9 months, we're going to start seeing some of those examples actually popping up.
And with debt going into these projects, that's another timing issue that you want to be cognizant of. A lot of times these construction loans come with a pre-leasing requirement, or some sort of advancement of your project. If you have to get 50% pre-leased on a strip center or an office building before you can pull your construction loan, now you got to factor in that lease up period into this time frame. So now that's another another time frame that you need to work into, along with entitlements and DRC and building permit, is your debt. So you want to be working on your term sheets and your construction loans up front.
So it sounds like this could be a great tool for nonprofits, all in all. Would you agree?
Definitely can be,
yeah.
yes.
Okay. So we've got just about 10 minutes left with this panel. What I'd like to do is just ask the panel if they want to take a minute or two with any closing thoughts, maybe any topics that we didn't get to. And keep in mind, we do have a networking session following at the very end of this program. So if you had a question that didn't get answered, you'll get that opportunity. But would you like to start off, Dan?
Sure. I'd just like to add, I think Sean Parker's intent was to sell Facebook stock without paying taxes. And, but this is, what's really cool about this tax bill and this law is that it really is one of the recent bipartisan laws that have been passed in Congress. It gets support from both sides of the aisle. It started under the Obama administration. It got finished under the Trump administration. Just congressmen and senators from both sides, Republican and Democratic governors that are supporting this for all the right reasons. It gives me a little hope to think that we can still pass laws in this country and something this substantial, that things can still get done in Washington. So I'd just like to finish on that note.
Okay. How about from you, Brett?
I would say, we're still kind of in that Wild West territory. And also, by the way, if anyone wants a copy of the presentation, just email me. My contact info is in the slides. I've seen a lot of people taking pictures with their phones. You don't have to do that. I'll email you a nice clean PDF. But I would say that, the guidance is going to be really helpful. The guidance we've gotten so far has been mostly taxpayer favorable. There's a handful of issues that are going to be worked out, but there was a lot of lobbying done at the end of 2018. I think that Valentine's Day hearing that was held at Treasury, the doors were closed because so many people showed up. I think there were over 200 comments that were made. So a lot of people are paying attention to this. The administration and both sides of the aisle want this to work out. So we're very optimistic, and the timing is ripe. This is the year to do it.
Brian?
We've been presenting at these types of panels, not just across Arizona, but across the country. And what we've experienced is that Arizona is probably one of the most actively engaged states across a lot of different levels, but in particular at the municipality level. So what's very important that we would like to make sure we come out of today with is that we keep these lines of communication open. There's a lot of people that are involved in the business community, CPAs, attorneys, financial advisors, people involved in commercial real estate that probably have clients that could take advantage of these programs, whether it's because they have a company or a project that needs capital, or they're going to be experiencing a significant capital gain event. So it's very important. This is a great start because everyone's learning a little bit more, but we have to make sure that we keep those lines of communication moving forward. From Caliber's standpoint, we literally don't have a team that goes and looks for projects because we have people bringing them to us. And one of the best sources of referrals of qualified projects for us has been people involved in economic development, other construction companies, financial advisors, because of the fact that they know when there may be a good project out there that will directly benefit the community. And I'll give you an example of that. One of the opportunity zones is in an area that a municipality has been trying to attract more light manufacturing. Well, the reason why they weren't able to bring in more light manufacturing was just because they didn't have the product there. So an opportunity fund, along with the developer, can absolutely be used to bring in new tenants for office buildings, also for manufacturing distribution facilities. So make sure that you're identifying within your community what you're really trying to attract. And if you already have the interest there, whether it's for expansion or attraction, and it's in an opportunity zone, those are the types of conversations that we would love to have with you so that we can walk through all the different issues that we've all heard about how do we actually meet the requirements. But at the end of the day, if you don't have something that's going to end up making economic sense for your community, it's probably not going to be a project that's going to go in there. So it really comes back to what does each of the communities need, and we love being involved in those conversations. So feel free to contact us about anything.
Thanks. Adam?
Unfortunately, we ran out a little bit of time for the compliance side of it, but a couple things that I wanted to make sure that come across is the 90% test that we've talked about, and that has a 6-month testing period. If you don't hit that test, the penalty is monthly. So your accounting has to be in order. You have to track everything by month because the penalty is calculated each month of the year if you have that penalty. And it's based on federal rates, but it's basically the difference between the 90% and the amount you actually have. So that difference has, based on the IRS rates, 5%, right now it's 6%, is the penalty on that. So if you're not hitting that, that's going to definitely hit your investment and make it not as good of an investment. Basis is an issue as well because you don't have basis in your investment until you recognize the gain. So once you hit that first 10% excluded from gain, you get that much basis, you get the next 5, and then you don't get the full basis in that investment until 2026 when you recognize the rest of the gain. So depending on if you're doing your own project or if you're investing in others, if you're doing your own in that initial year, you might have a loss or something just getting up and running that might not allow you to take that loss because you don't have the basis. So that's something to consider when you're doing your own project. And then as far as investing into the fund, these are generally targeted to higher income people. To get the benefit of it, if your income is $50,000, you have a $20,000 gain, you're already paying 0% tax on that gain. So it might not be worth investing into this. You still get the long-term benefit of it, but initially you're deferring a gain that's not going to have any tax. And the issue is when you recognize that gain in 2026, what's your taxable income going to be? What are the capital gains rates going to be? That's unknown. 1031s we didn't get into a whole lot, we kind of discussed, but those are some of the key issues I think people need to be aware of, is that the accounting needs to be in order because you have to support it as you go, and if you hit that 90% test, it doesn't necessarily disqualify you, but your penalty is going to be based on that by month, not just at the end of the year or even at the 6-month test.
Great. And last but not least, Rob.
The thing that I don't think we touched base on quite enough is cash flows and diminishing returns. So cash flows, funds are 10-year funds. You're not going to speculate on a 10-year fund. You're not going to go out and buy some land you're just going to pay taxes on for 10 years. So opportunity zone projects need to produce cash flow. So things that produce cash flow have the potential to be opportunity zone investments for opportunity zone funds, and the more cash flow they have the potential to produce, the better off they're going to be. So diminishing returns. We have a program as it sits that has diminishing benefits as time goes on. Somebody who invests today gets to borrow money from the IRS for free until 2027. Somebody who invests next year still gets to borrow until 2027. Somebody who invests in 2026 has to pay their taxes right then. So over time, this program, unless it's modified, the benefits decrease from the reinvestment of the tax benefits. And so that being the case, if you have property in an opportunity zone and you want to benefit from the program, you need to try to get your property ready sooner than later, because the closer you get to 2026, the lesser the benefit from that reinvestment is. So.
That's great. Let's give a big round of applause for our panel today. We're going to take just a moment to switch out our panel, and so stay tuned. Just a moment.
So we have representatives from the city of Prescott, the town of Camp Verde, town of Prescott Valley, town of Wickenburg, and of course Yavapai County. And again, I'll let them introduce themselves and get a little quick bio. So maybe Haley, we'll start on your end and end up with the county, David.
I think we need the clicker.
You mean this thing?
Yeah, you got it, sir.
Hi, my name is Haley Smith, and I am about to graduate from Arizona State University with my master's in public administration. And I'm currently interning with the city of Prescott, and so I am honored to be here and present this information to you.
Hi, everybody. My name is Pamela Green. I'm the Economic Development Director for the town of Wickenburg. And first off, would like to thank the group that worked so hard to put this together. What an educational opportunity for all of us, and much appreciated, and look forward to enticing you to come to Wickenburg for some of the projects that we have that are ripe for this.
Good afternoon. My name's Ben Hooper. I'm the Economic Development Coordinator for the town of Prescott Valley.
I'm Steve Ayers. I'm the Economic Development Director for the town of Camp Verde. And we're excited to be here, and I actually want to pass on the thanks to everybody who put this thing together. This is one of those kind of rare opportunities where at least a small community like ours, which is imminently tied to this project, to this opportunity zone opportunity, to come out and talk a little bit about what we've got going.
Thank you. I'm Dave Williams, Director of Yavapai County Development Services. And I just want to kind of reiterate, what Steve just said here. This has been an effort from the beginning on a very short fuse where all of us were able to come together very quickly to get these zones established. So I think it's a fantastic collaborative effort. I think this panel today, our speakers earlier, I think that absolutely speaks to that. And in our involvement with all of our agencies, with the community to try to help these come forward. So I want to thank all of our attendees here today for helping make this possible. So.
All right, well, I'll start us off then. So I want to start with just a basic map of Prescott's Opportunity Zone, and then we're going to build off of that. And so I want to walk you through the boundaries. So down here, that bottom boundary is Gurley Street. Then all the way over to the right, we have State Route 89. And then all the way to the left, we have Miller Valley Road. And then the reservation makes up that upper boundary there. Prescott's Opportunity Zone is almost 2 square miles, and about 5,000 people reside within the zone. And in looking at this demographics table, we see, as expected, that the median household income for people within the zone falls well below that of the city, county, state, and country. But interestingly, the percent of people with some college in the zone is about 10% above that of the city, county, and state, and almost double that of the country. So now here's another map that we're building on that basic map. So as you can see here, a lot of Prescott's key assets are located within the Opportunity Zone, such as the Regional Medical Center, the VA Hospital, Yavapai College, where we're all currently sitting, as well as the local high school. And it's important to note that each of these key assets are 2 miles or less from Prescott's iconic downtown area down at the bottom. Now, in order to get a better idea of the types of projects that would be ideal for Prescott's Opportunity Zone, I want to start by first talking about the zoning composition and then giving you just a sampling of properties that are for sale in the zone. So as you can see here in the yellow area, that is mainly multifamily zoned land parcels. And then over in the light green, we have more of Prescott's industrial area. And then down in the bottom, we have prime downtown business land parcels. This is the same information, just in the form of a pie chart. And so our key takeaways here, or highlights, are that multifamily homes make up almost half of Prescott's Opportunity Zone. Almost 20% of the zone is industrial, and over 20% of the zone is business, with 7% being downtown business. And it's also important to note that we have about 100 vacant land parcels in Prescott's Opportunity Zone, which make up about 5% of the zone. And here are the exact number of land parcels, if it's easier to see the information that way. So again, almost 1,000 multifamily home land parcels. Here's a map of the different vacant land parcels in Prescott's Opportunity Zone, most of them located in the multifamily area or the industrial area. So now I want to give you 5 different properties that are for sale in Prescott's Opportunity Zone. The first is this property, which is zoned as industrial and is over 9,000 square feet, sitting on about 1.5 acres of land. The next property is also zoned as industrial and is just down the street from the first one. And it's much larger at over 67,000 square feet, sitting on 3.5 acres. And this was previously used as a company headquarters. And so all that gray area in the back was used for parking. So this is a prime property in Prescott's Opportunity Zone. The next 3 properties I want to talk about are zoned as downtown business. And the first is located on the corner of Sheldon and Marina. Many of you may have been to this building when it was operating as a restaurant, but it is now for sale. And it is a little over 3,000 square feet, and again, sitting on a prime corner in Prescott's Opportunity Zone in that downtown area. The next 2 buildings actually would be ideal for mixed use projects because they already have retail on the bottom, and then their upper floors could be transformed into either a hotel or some kind of residential living. So they're both on Cortez, and this is the first building at over 25,000 square feet. And as mentioned, we have retail already on the bottom, and the second and third floors are currently operating as a hotel. And the next property is right across the street from that, but double the size at over 50,000 square feet. And this building also has a parking garage attached to it and is a very important building that's very valuable right now. So this is just a summary map of the different properties that I've gone through, which are also located on your table. We have flyers there with the address information for those. And so in light of these 5 different properties that are for sale, the 2 main types of projects that would be ideal for Prescott's Opportunity Zone would either be mixed use projects, and again, utilizing that first floor retail that's already existing and then transforming those upper floors, as well as industrial projects, whether that be a company headquarters or a business incubator, as we've talked about today. For more information on Prescott's Opportunity Zone, please feel free to contact Wendy Bridges, and thank you for your time.
I'll just sit here. Clicker. It's not mine. Very good. So our presentation is a little bit different. A little story about Camp Verde. We are a little different from Prescott and some of the larger communities in Yavapai County that have these zonings. We do value our quality of life over there. We are Tree City, USA. We recently got designated as the 5th community in the state of Arizona as an international dark sky community. We have spent a considerable amount of time and effort to help grow the Verde Valley Archaeology Center. We have 17 miles of free-flowing river through the town, which we highly prize. We have a downtown area we're trying to revitalize. We're also building parks and other pieces along the Verde River. But the town of Camp Verde has also taken a very aggressive stance towards its growth. We changed our last general plan, so we have actually split the town up into character areas, so we were eminently prepared for this kind of an opportunity to show up, in that we have corridors in the town. We actually split it up into 9 different areas so that we don't have some sort of blanket section of the town or blanket language that tells you what we want in an area. The corridors that we have in the Opportunity Zone are well spelled out in the character areas in our land use plan as being, as, pardon the term, but we call it balls to the wall growth in that area. That's actually an aeronautic term. Thank you. So one of the things we did is when we could not get ADOT to fix the 260 corridor out there in 2013, we hired a lobbyist and we actively went to the State Transportation Board, and with $30,000 in the cooperation of the city of Cottonwood, we got $67 million, and that road just finished. So we now have a four-lane road that stretches the full length of the corridor with 7 modern roundabouts and access points all along that. It was a huge step. We didn't know this opportunity was coming along, but the timing was pretty impeccable. On top of that, we couldn't get Verde Valley Medical Center to give us a modern medical facility, so we brought Banner Health, John C. Lincoln, and I forget who the third one was, into town to talk to them about moving into town. That moved us in their priority list, we'll say VVMC's priority list, from number 7 on the project list to number 1, and we got them to build. So for your information, my background has always been in the private sector. I took on this job as an economic development director in my town because I kept watching it squander opportunities, so that's kind of why I'm here. We have along that corridor, you can tell we have everything we need along the 260 corridor in the Finney Flat area, with the exception of a sewer line, which it covers the corridor, or I should say our zone includes the I-17 and 260 area. It includes 5 miles out on the 260. We have a fiber optic line that runs the full length of that corridor. We have 2 fiber optic lines that crisscross at 17 and 260. We have a sewer which extends across west of 17, but we have about a 4-mile corridor. We are aggressively putting together a package to get that sewered. Once we have that, all utilities will be in place on that corridor. We have some projects already moving ahead right now. We have roughly 325 acres has been purchased by an Opportunity Zone funder. The first project is this RV park. It was the first one that we have that's being built. If you travel 17, you'll see it out there. I've heard a lot of talk up here earlier about time being of the essence. I want you to know that they closed escrow in April of last year, and we had building permits in their hands in September. So we have realized that the opportunity, if we choose to seize it as a community, we need to move ahead. We need to have our act together. And Rob reiterated that the reason that they continue to invest in Camp Verde is we have demonstrated that we want it done. And they brought projects that are compatible to the areas that we want those projects done in. And it doesn't require, we had to rezone 2 of those properties, and they've all been rezoned. And we did those within like 30 days, 60 days. It's pretty quick. As long as they fit the town's general plan, we're game for it. So that's basically it. That's my pitch. If you want to come to Camp Verde, everybody has a map of the zone. You have my phone number. Some of you have my cell number. Some of you have my office number, but that was sort of a glitch. But feel free to give us a call. Thank you.
I'll stay here. I'll stay seated as well. All right, so let's take a look at Prescott Valley's Opportunity Zone. So before we dive into the excellent development potential within our Opportunity Zone, I want to highlight just a few quick pieces of demographic information. So first of all, Prescott Valley is the largest, the fastest growing, and the youngest community in Yavapai County, and none of those metrics are projected to change moving forward. Population of within the town boundaries is about 45,200. Population in the region is about 210,000 residents. That's within a 1-hour drive time. That 1-hour drive time encompasses both our workforce as well as folks who regularly shop and recreate in Prescott Valley and Prescott. I have some additional demographic information included in the packet that is in your folder. So let's jump into the good stuff. This is Prescott Valley's Opportunity Zone boundary. It encompasses some residential areas on the eastern and the western edges of the zone, but the center of the zone and the frontage along the north side of State Route 69, that comprises our entire central business district. So showing here another way, an aerial of Prescott Valley's Opportunity Zone. Here's the approximate boundary. As we explore some of the current assets within the zone, I think you'll start to see some of the wide range of development possibilities that would make sense from a site location perspective. So first of all, we have the Fane Signature Group is in their final stages of phasing the opening of a 214-unit luxury apartment complex, the first residential project in the emerging downtown Prescott Valley. The Findlay Toyota Center is a 5,500 plus seat multi-purpose arena. Of the more than 1.6 million visitors that come to our region each year, some of them are attending one of the many sporting events, concerts, and trade shows that are hosted at the Findlay Toyota Center. Yavapai Regional Medical Center's East Campus is an acute care hospital. This campus is also home to YRMC's state-of-the-art birthing center, breast care center, and the Del Webb Outpatient Center, as well as a myriad of private medical offices and services clustered around the edges of the hospital's campus. While we have 3 primary hotels in town, only the Hampton Inn is currently located in the Central Business District. The town of Prescott Valley's offices are located along the zone's northern boundaries, and a multitude of retailers are located in the zone as well. While I included some of the national brands and stores with some of the largest footprints, there are hundreds of other smaller national and local businesses with thousands of employees that come to work each day in the Central Business District. In fact, 8 of the town's top 15 employers are located inside of our opportunity zone, representing one of the densest employment nodes in town. So let's take a dive into what the Prescott Valley's development needs are. And notice I said development needs, not wants. I'm going to give you a brief overview of sectors that have a demonstrated market demand for Prescott Valley, not a list of our hopes and dreams. So number 1, retail. The Prescott Valley Opportunity Zone encompasses 2 of Prescott Valley's 3 major retail nodes. A retail gap analysis performed in 2018 identified gaps pretty much across the board, but the 3 largest needs are full and limited service restaurants, pharmacies, and apparel. In the medical arena, as I mentioned, there's several medical offices and services clustered around the hospital. While the opportunities here are not limited to just these 3, the hospital has identified speculative primary care offices, assisted living, and nursing homes as our top 3 needs. In the residential sector, both single and multi-family rentals sit at pretty much 100% occupancy at all times. I think anybody who's tried to find a rental in Prescott Valley can identify with the difficulty. There is a major need for market rate and low-income residential builds, especially in the area of multi-family. In the hospitality sector, as I mentioned, we only have 1 hotel in our Central Business District, despite the fact that this is our primary recreation and business node. The occupancy of our local hotels sit at or above 80% pretty much all days, and nearly 100% every weekend. In the entertainment arena, I mentioned that we're the youngest community in Yavapai County, and unlike the rest of the county, our age distribution is fairly equal across the board. We need additional entertainment options that kind of appeal to all ages. And then in the office arena here, our local brokerage community has identified that Class B office space, somewhere in the 1,000 square foot range, as well as cooperative working spaces are 2 needs that they struggle to meet client need in Prescott Valley. So, during the panel discussion, we heard about the necessity of municipalities to be sensitive to the time constraints imposed upon Opportunity Zone investors. The idea that time is money to the development community has never been lost on the town. We have always taken a solutions-oriented approach to development in Prescott Valley, and I believe anyone in this room who's developed in Prescott Valley, of which there are many, would attest to this fact. The key is including the town in your development discussions early in your planning through our initial project review process, which we highly suggest that you do during your, either before or during your acquisition of any property. The initial project review process helps to establish a timetable and identify some potential challenges to ensure that your project is able to, number 1, maximize the Opportunity Zone tax benefits, while also, number 2, completing the project inside of the 30-month requirement. The IPR process will help walk you through everything from potential zoning change requests through your final development plan approval and the issuance of your building permits. Folks, it is not unusual for properly submitted building permits to be approved in Prescott Valley in as little as 2 weeks. So here's my contact information. It's also included on your flyer. I'll be available during the networking session today. Additionally, several of our property owners and brokers representing properties in our opportunity zone are in attendance today. As we all know, time is of the essence, so let's get the discussions rolling today. However, my email, phone number is included if you want to contact me at a later date. Thanks so much for your attention. I look forward to working with you.
All right, I'm going to come up here and stand up because y'all are kind of a scary looking crowd when I look out here. I might need to, get out of here quickly. I'd invite you to join me and allow me the opportunity to speak to you from the heart in regards to representing Wickenburg. About 3 years ago, when my husband retired, we had a set of goals and objectives of what we wanted to do in the next phase of our life. And one of the things we wanted to do was to find a small town community where we could have the opportunity to give back and to get involved and to make a difference. We both had very successful careers in the plastics, manufacturing, corporate America world, and there are nights that sometimes when you're in the plastics world, you wake up and you feel a little guilty every now and then. So we wanted to find a way to give back and a place where we could really do that and make an impact in a positive way. And Wickenburg had always been a favorite vacation spot for us when we came to Phoenix area to visit family. So just by a show of hands, who here has been to Wickenburg or spent time visiting? That's fabulous. So you know what I'm talking about. Wickenburg has a very special culture and environment. You talk about being the youngest community. We might actually be one of the oldest communities. Our major demographic is for retirees, and we're very proud of that. We try to focus on finding the right types of amenities and entertainment and support for those individuals, as well as making opportunities for families and a place to grow. It's a wonderful place to live and raise a family. So we're doing that balancing act, and that's pretty exciting for us. One of the biggest things that's happened to Wickenburg in a while is the development that is known as Wickenburg Ranch. So the Van Tile Group and the M3 Group came in and, along with Trilogy, created this fabulous it's not a retirement, it's not 55 or up required neighborhood, but it's a resort style living. And within their residents right now, they have a representation of 39 different states. So they pulled their 500th permit, and of their residents, we're already representing that diverse group across the United States. And so they have really brought in a focus with their marketing efforts in millions of dollars of advertising that they've done that mentions and brings people to Wickenburg. The golf courses there have received numerous awards, been represented in international award categories, and it's really brought a new focus to the town. So we do thank them, and we're very grateful to have them, and it's been very well received within the town itself. The day-to-day population in Wickenburg is about 7,200 people with a regional impact area of about 30,000. But one of the things that we're known for is obviously tourism, and we have a great population of snowbirds who come and stay with us during the season. So we have been known in the past as the Dude Ranch capital of the world. I think we're getting known as the grandparents' capital of the world. And we're also known as the team roping capital of the world. And so I don't know, from that perspective, when those additional thousands of people come in to compete and to be a part of our community. We find great needs for hospitality, for entertainment, for restaurants, for the different events that take place. The economic impact is huge. The picture there in the center, which is an aerial view of one of the arenas downtown, during the first week of December, over $2 million worth of prize money was won at that facility. So it's just serious. It's the equivalent of having a professional football team that's in your town, but our town is 7,000 people. So we do have a big population of customers that are eager to find opportunities to frequent businesses and to be a part of economic impact. I put this this map on my slides because if you were just flipping through the Opportunity Zone maps, you can't even see where Wickenburg is. I think there's 1 pixel of green. But when you blow it up, it's nearly the whole town. Our entire downtown area and several miles of space after the downtown is included in the Opportunity Zone. So when we talk about workforce housing, different industrial opportunities, lodging, restaurants, it's all represented. We have space for all of those to come in. In this map, I just wanted to highlight very quickly in the downtown area some of the starred locations. You're going to see opportunities for dirt lots that are shovel ready and have a set of plans that maybe has already been reviewed and approved but got set aside, that would be available for somebody to come in and pick up and quickly find that speed to market. We have infill opportunities. We have rehab opportunities for different buildings that unfortunately are empty now that are in the downtown area. So we also have what we refer to as zombie subdivisions that unfortunately at times in the recession have those plans at PAD, everything ready to go, but it's been set aside. So again, we look forward to finding different opportunities, working with you, again, the community development, planning and zoning, town council. We try to be as supportive and easy to work with as possible. We want you to become part of our community, part of our Wickenburg family, and I would just encourage you and open an invitation if you're interested. Please come and see us. Please come and talk to us and let us find that win-win situation and become a part of the Wickenburg culture. Thank you.
Okay, we're going to bring up one slide that shows the Yavapai County Opportunity Zone. I didn't prepare, quite frankly, a slideshow presentation because our Opportunity Zone is just a little different than the others that you've seen today. Our Opportunity Zone extends basically from Paulden all the way north to the county line. There we go. Is that it? Yeah, that's it. So we start just north of Paulden, go all the way to the county line. But our Opportunity Zone, when you really look at what is available up there, we're really talking about 2 communities. We're talking about Ash Fork and we're talking about Seligman. These are not tech areas. These are not aeronautical areas. Supervisor Thurman's laughing at me. These are distinctly different than the previous ones you've seen. These areas truly are a tourism and, more importantly, a transportation type of an environment. The I-40 corridor in this area carries 32,000 vehicles per day, with a large portion of that being heavy trucks. Prior to the recession, we actually had significant investment ready to trigger in the Ash Fork area in the form of truck stops. They're needed. This is a jumping off point from 89 going north. It's really that first chance to hit a truck stop to then break off and go east or west on I-40. Unfortunately, the recession, that's okay if it's going to rotate, guys, don't worry about it. Unfortunately, the recession eliminated that possibility. But what we have here is several large tracts of land conducive to those types of transportation uses. Seligman as a town is a heavy tourist town now. It's very conducive to RV parks for people coming through the community. As we saw with the Mary Realtor story, our zone is really key to be able to trigger those types of uses. Restaurants are in high demand up there because of the community that's driving through the area. This is a stopping point for people on the way to the Grand Canyon. It's one of the reasons why we have so many cars that come through here each and every day. They're also prime for some creative mixed-use projects. We have several hotels in dire need of renovation to bring them back to life. So our zone is a little bit different. From an entitlement point of view, should we have to do a rezoning on these properties or a use permit or something to allow for what the proposed use would be, our process can be done in as little as 4 months. During that time frame, we would absolutely take grading plans and building plans at risk so that by the time you receive your board approval, you're essentially ready to go. Yavapai County, quite frankly, has a significant interest in trying to see these areas come back to life. I wish we had the downtown Prescott. I wish we had those. We don't. But what we do have is a very unique opportunity, especially on the lower end of the opportunity zone investment for extremely affordable land in key areas with very high traffic volumes to serve an absolute niche need that is not going away in 10 years. We know that. We will always have heavy trucks running I-40. We will always have tourists going to the Grand Canyon. We'll always have people stopping in Seligman just to see the town. One of the things that I am amazed with every time I drive up there is the international draw that Seligman has. That is something I don't think any of our other communities, quite frankly, can say. When you look at what goes on up there, it is truly incredible. It's communities that are ready to truly move to the future. So with that, I believe I'm the last speaker, so if I may, does anybody have any questions for the panelists? If not, I know we will all be available. Actually, we might have one in the back here. Where's the microphone? Or if you want to yell out, I'll repeat your question for the record. Well, I can address it for the county since I'm here right now. The land that we have available up there is not land we could leverage for an opportunity zone right now. It's land that's already earmarked for other purposes actively. It's being used for transportation needs, for public works, the airport, those types of uses, wastewater, those types of things. Anybody else?
I would say that no. Wendy can address this too.
It's on the bottom.
What she's saying for the record is they do have some, but you don't know the status or ability. There we go.
There we go. So the city of Prescott does have some small parcels. It's mostly things that are used for like easements, nothing you could develop on, nothing you could put a project on. There are a couple of significant pieces of property that are currently under development. If you've heard about our new Hilton Garden Inn project that's going in near our downtown, that is happening on city land within the opportunity zone. And I'm not, off the top of my head, I'm not familiar with any significant sized vacant parcels that the city owns. So in answer to your question, I don't think so, but I'm happy to look into that for you.
And I also want to clarify that the map that I showed of vacant parcels for the city of Prescott does not include any city-owned land. So that's all vacant parcels.
For the town of Prescott Valley, we do not own any of the parcels in our zone. However, we do have excellent relationships with all of the property owners or their brokers, and so get in touch, and I will pipe you in with the right folk.
We do have a 5-acre parcel in the zone that's owned by the town of Camp Verde, which has been earmarked at some point in the future to possibly go out on a request for proposals to do some kind of possibly affordable housing. Hasn't been decided from the council level as to how they would like to include that piece. But if you have an idea, we'd certainly like to listen.
And in Wickenburg, the town does own multiple pieces of ground that are in the opportunity zone. Downtown, within a few miles of downtown, there's opportunities for multifamily housing. And again, we'd be very happy to talk to you about how we could find a win-win situation.
So, at the risk of sounding like Captain Obvious, this campus, all of its acreage, sits in the middle of Prescott's opportunity zone, just in case you hadn't noticed that on the map. Public-private partnerships appear to be an opportunity. I'll just point that out and leave it at that. I want to personally thank you for attending and participating, and to my private partner friends, to the municipalities, and from Yavapai College, thank you very much.